Understanding tax should not feel like decoding a secret language. Yet, if you're running a business in South Africa, you've probably heard phrases like, "You must pay provisional tax, SARS is expecting your IRP6, or your income tax is different from provisional tax." You might wonder if they all mean the same thing. You're not alone. Many entrepreneurs confuse income tax and provisional tax. This confusion often leads to penalties, surprise tax bills, and unnecessary stress. Let's clarify these concepts. Let's start with income tax. It is simply the tax you pay on the money you earn. If you're employed, your employer deducts PAYE, pay as you earn, and pays it to the South African Revenue Service on your behalf. But if you run a business, freelance, consult, or earn income outside of a salary, no one deducts tax for you. You are responsible for declaring that income and paying the tax yourself. This is where provisional tax comes in. Provisional tax is not a separate tax, it is a system that allows you to pay your income tax in advance. SARS uses this system because it doesn't want to wait until the end of the year to collect tax from business owners and others earning untaxed income. Instead, you estimate your annual income and make payments during the year to avoid a large tax bill at year-end. Provisional tax generally applies if you earn income not subject to PAYE, such as business profits, freelance income, consulting fees, or rental income. If you only earn a salary and PAYE is correctly deducted, you are usually not a provisional taxpayer. But the moment you start earning income on the side, the rules may change. The purpose of provisional tax is practical. Imagine running a business and making a significant profit but paying no tax throughout the year. When year-end arrives, SARS sends a large tax bill that you're not prepared for. This can be a huge financial shock. Provisional tax prevents this by spreading your tax payments across the year, helping you manage cash flow and avoid financial shocks. Provisional tax payments are typically made twice a year, with an optional third payment to avoid penalties if income was underestimated. These payments are submitted using an IRP6 form via SARS filing. At the end of the tax year, you still submit your normal income tax return. This is an ITAR 12 for individuals or an ITAR 14 for companies. SARS then calculates the final tax due, subtracting what you've already paid. If you paid too little, you settle the difference. If you paid too much, you receive a refund. But if you fail to pay provisional tax when required, SARS may impose underestimation penalties, late payment penalties, and interest. This can lead to large final tax bills. Many entrepreneurs only discover this after ignoring provisional tax for years. Understanding whether you are a provisional taxpayer is key. If you earn income without PAYE deductions, run a business or side hustle, earn commissions, freelance, or receive rental income, you are likely required to pay provisional tax. Assuming SARS won't notice is a costly mistake. Banks, clients, payment platforms, and regulatory bodies share data. The system is more connected than many people realize. The good news is that provisional tax is not something to fear. It is a sign that your business is generating income and growing. When handled correctly, it helps you manage cash flow, stay compliant, and build credibility. Organized entrepreneurs plan for tax. They set money aside monthly, keep proper records, avoid underestimating income, and use reminders to meet deadlines. In the end, income tax and provisional tax are not enemies. They are part of running a real business. If you are earning money outside of a salary, SARS expects you to take responsibility. That responsibility isn't a burden, it's proof that you're building something real. The goal isn't to avoid tax, the goal is to grow a business worth taxing.